Hello and welcome to Markets Today. I'm Lata Venkatesh. With me is Surabhi Upadhyay. And it was a second day of selling on the markets. The selling was pretty ferocious, even if there was a little bit of short covering towards the end of day. And now this two-day selling raises the question whether this is mere profit taking or the markets are changing direction.
Absolutely, Lata. Yes, we will get you lots of opinion and analysis to go through that question and try and find some answers. Let's first start with the headlines. A choppy day of trade on Dalal Street with benchmark indices finally ending with a 0.5% cut. The Nifty barely manages to hold above 8,700. Realty, capital goods and pharmaceutical stocks see selling pressure, but oil and gas stocks buck the fall.
Mid-cap index falls more than the frontliners, ending down 0.7%. Trader favorite stocks like NCC, that's Nagarjun Construction, and JP Associates face pressure. Realty collapses 12% as a US research firm alleges the company has fabricated some of its figures and overstated its EBITDA. Gammon India, however, surged 13% on news of new order wins.
It's been a muted performance for the country's largest tech outsourcing company, TCS. The company's dollar revenue falls 0.8%, while FY15 margin comes in at 24.1%. The management, however, strikes an optimistic note on FY16, saying the deal pipeline looks strong.
And Innocent Bank delivers another steady quarter with profits rising 25% and net interest income growing 18% in line with street estimates. The bank reports an improvement in asset quality with gross NPAs or non-performing assets declining 16% over the previous quarter. All right, those were some of the headlines from the street, and here are the big voices that we will be getting for you on the show today. We have Jonathan Garner, Sridhar Shivram and Vineet Bhatnagar, all market gurus speaking on the markets, and from the corporate world, N. Chandrasekhar of TCS, Ramesh Sopti of Innocent Bank speaking on their respective results, and Sanjeev Kapoor of SpiceJet on the road ahead for his company.
So lots of opinion coming your way, but before we get to that, a quick check on the markets themselves. Bears prevailed once again on Dalal Street in what was yet another volatile session. The bulls tried to recoup some of those losses in the last hour, but the major indices still ended in negative territory. The Nifty was trading below the 8,700 mark for most of the second half of the day, but then it just about managed to close above that level in the last few minutes of trade. The Sensex also lost over 130 points to slip further away from the 29,000 mark. Mid-caps underperformed blue chips, with the mid-cap index losing nearly 1%. Anuj Singhal now joining in with the day's market action. Anuj, Bears once again winning this tug of war.
Indeed, it's small battles which are being won by bulls and bears now almost on a daily basis. The big question is what happens to the bigger war, and for that we still don't have an answer. But about today's trade, it was quite disappointing, at least the first half. In the second half, there was a moment when it looked like the bulls are making a big comeback and the market would actually end in the green. But in the last 30 minutes, the recovery was sold into, and that was the disappointing aspect if you ask the bulls. The second round of selling that came in. Also, the mid-caps were quite weak in today's trade, and pharma and cement were the sectors that led the market down, or at least were among the biggest losers. Let's talk about some of these stocks then. Cement right on top, and a lot of that has to do with the earnings build-ups. You know, stocks like ACC, Ultratech, Ambuja, all were down about 3%, and there is a genuine call that earnings in cement will disappoint. Apart from that, pharma stocks, we've been pointing that out for the last 2 days. There's been some profit booking, some delivery-based selling in pharma stocks. So today also you saw Sun Pharma, Lupin, Cipla. They were all lower by about 2% in today's trade. Among heavyweights, the stocks that dragged the markets included TCS, that was down 2%. Larsen & Toubro was down 2% as well. And ITC was lower by about 1%, mostly on profit booking after the last couple of days of rally. On the gaining side, oil and gas stocks, at least the upstream ones, looked good because of the kind of rally that we saw in crude prices. So ONGC and Cairn were both up about 4%, and telecom has been having a good time of late. So Idea was up about close to 2%. Now onto the mid-caps, high beta stocks was selling off today. Stocks like Rolta, JP Power, NCC, they were all lower. Rolta, of course, had to deal with a negative report as well. Apart from that, you had HDIL, Indiabulls Real Estate, Dish TV, they were all lower between 3 to 5% in trade. Let's see how the markets react to TCS earnings tomorrow. And then, of course, the big question would be that, the kind of phase that we're seeing in the market, is it just profit booking, or has the fresh downtrend started in the market?
Oh yes, that's the key question that investors and traders will look forward to. Thanks a lot for that, Anuj. And now off to some of the key earnings which came out today. First up, IT major TCS came out with a muted set of numbers, of course, after market hours. These are numbers for the fourth quarter. The net profit has come in at 5,906 crores, while both the dollar and rupee revenue took a hit in the quarter gone by. Rupee revenue has fallen 1.1%, coming in at 24,220 crores, while the dollar revenue has fallen 0.8%. The FY15 margins have also taken a small hit to come in at 24.1%, which when taken into account with the one-time bonus that is being paid to all its employees is largely in line with expectations. The TCS management admitted that fourth quarter has been weak due to cross-currency impact. Let's listen to N. Chandrasekhar himself.
Vis-a-vis estimates, market estimates, both operating margin and the net profit net margin is above the estimate. Yes, on the revenue line, a tad below the estimates. And basically it is the three headwinds I talked about. We've had a dip in telecom, we have had a dip in diligent revenues, we had a dip in energy sector. All of these three we called out, saying that we are seeing headwinds and we are seeing volatility. And the energy sector is a pretty small sector from our point of view, so it's very difficult to predict given the current conditions. But otherwise, if you see any of the other mature sectors, there is no surprise.
Well, TCS has also decided to give a one-time bonus to its employees to commemorate 10 years of its listing. The IT major will pay a week's salary for every year spent at the company at a total outflow of 2,628 crore rupees. Well, it wasn't just TCS. Another IT services company which came out with results today was Mindtree. Profit fell over 8% when calculated quarterly and was marginally shy of expectations. Rupee revenue rose over 0.5% to 918 crore rupees. That was bang in line with estimates. Dollar revenue growth was absolutely flat at $147 million, or rounded off $148 million. The company's forex loss stood at 13 crore rupees during the period.
All right, then come the banking results. Banking stocks may be under pressure, but IndusInd Bank posted a stellar set of numbers for the fourth quarter today. Let me take you through some of the interesting details. The net interest income of the company for the fourth quarter increased by 18%. Not a small number, so it goes up to 925 crores. But more importantly is the profit growth, 25% higher at 495 crores, largely in line with estimates though. What of course was the pleasant surprise was the fall in the gross NPLs, or bad loans that are not paid back. Gross NPLs for the quarter fell by 16% from the previous quarter, and as a percentage of total assets fell to 0.8% from 1.05%. So that's a significant achievement on the part of IndusInd. As well, the net NPLs remained steady at about 0.3%. Provisions, which is the amount of money you set aside from your profit to pay back loans that are not paid back, that fell by 11%, clearly indicating that the company had to set aside less money to pay for bad loans. Margins of the company also came in good. It came in at 3.68%. That's slightly above the 3.67%. And they are well on their way to getting better in the current quarter, because IndusInd also announced that the company will be cutting the amount of interest it pays on savings accounts. It used to pay 5% for deposits under 1 lakh. It will pay only 4%. Likewise for bigger deposits, bulk deposits, it used to pay 6%. It will now pay 5%. So margins are well on their way to improving. Let's listen to the Managing Director and CEO, Ramesh Sokti.
I think the general sensing is that growth will pick up, and probably during the full year we could see a 15-16% overall non-food credit growth. As far as we are concerned, even in a tough quarter like this, although pipelines are relatively dry, we've come up with a growth of 25%. For the full year also, we have shown a growth of 25%.
Okay, that was IndusInd Bank. Now, for all the action from the futures and options space, let's go across to Varinder Bansal. Varinder, run us through.
Well, thank you so much. You know, it was a yo-yo trade today clearly for the markets with the late recovery seen. Clearly, some of the pharma stocks led the recovery the last half an hour or so. But the good point was that 8600 put never saw any unwinding happening in, and that is a mark to watch out for. You know, the market is trading between that 8600 level and 9000 call. You know, 8600 put has the highest open interest outstanding on the put side, and 9000 has the highest call open interest outstanding on that side, on that option side. So watch out for these two, especially 8600. If any unwinding comes in, that will be the point to watch out for. But you know, few sectors which are weak. I'll start with the weak ones first. Clearly, cement was the one to watch out for after the price cuts news came in during the market hours. So Ambuja Cement, Ultratech, both the stocks were down today. We were seeing short build-up happening over there. Hero Motor was weak since morning. We saw nearly 11% build-up on the short side. Stock ended down nearly 3-4%. TVS Motor was weak, down nearly 3%. Fresh shots seen over there. India was real estate. SDIL, you know, was stocks which are weak. SDL saw some unwinding happening in the trade today, but few stocks which are holding very strong since morning were Aurobindo. That stock was up nearly 4%, ended at day's high. We were seeing long build-up over there. Kane India, ONGC, these were two stocks which are holding strong. You know, Kane India up nearly 4%, ONGC up nearly 3-4%. We were seeing solid gains happening in there. And one stock which is Wockhardt saw massive intraday recovery, recovered nearly 6-7% from day's low and ended at day's high. We saw massive short covering happening in the stock after the stock lost nearly 6% yesterday in the trade. So watch out for 8600 put. That will be important to watch out for in coming days.
Oh, we sure will. Thanks a lot, Varinder, for all those important details. But now on to a big market voice for a view on where they are headed. Jonathan Garner, the managing director at Morgan Stanley, believes that fourth quarter earnings in India will remain subdued, but an overall pickup in growth has ensured that he remains overweight on India. Listen.
We are expecting near-term continued relatively poor earnings growth. That's to do with the economic rebalancing that we've been seeing in India, particularly the reduction in government subsidies and some of the knock-on effect that's had on the consumer. But going forward, my colleague Ridham Desai, who looks after India specifically for us at this firm, does expect by the time we get to financial year 2017, earnings to be more than 15% ahead of current bottom-up street numbers. So then we should get a payoff from rising capital productivity and easing fiscal and monetary conditions and a pickup in overall growth. So we're still quite comfortable in recommending an overweight on Indian equities.
All right, that was a view from Morgan Stanley. On to another big voice on the show. Stay away from the equity markets for now, especially if you're looking for short-term gains. That's the clear message coming in from Sridhar Sriram of Siva Capital. It's the debt market that he'd rather look at for the time being for some value buying.
In the short term, the market's looking fully priced. So the opportunity on the, so if you ask me that if I have to put incremental money, would I be putting incremental money in the equity markets? The answer is no, at least in the short term. If I were to take a 18-month view, then possibly yes. Even then, I would say that we would get some sort of a correction. Like my personal view is this tax thing is huge. We are, you know, it's like a sword hanging. We could see a market correction anytime. If that is the view, then you shouldn't be investing in equity right now. Debt opportunities are looking better if interest rates were to continue to fall. We saw the inflation numbers yesterday. They continue to be extremely good.
Okay, that's ominous views, but useful advice as well. Let's take a break on that note. We'll be coming back with more advice for you. Sudarshan Sukhani will join in with his take on today's trade. Also some picks for tomorrow.